Welcome to Opal TV. I'm in Amsterdam together with Marc de Kloe. He is from ABN Amro Private Banking International, where he's head of funds and alternatives. Marc, for the last years you have been including alternatives into the offering of ABN Amro Private Banking. Tell me about your experience and where are you going?
Well, thanks, Matthias. I think, first of all, it's good to take a little step back into history to see where we were and what we were doing. When we first started with hedge funds, it was essentially only for the Swiss market. A lot of fund providers came to us and knew us in Switzerland, but that was about it. So when I started in this position about 6 years ago, what we first of all had to do was to build up our offering for the Swiss market. So that was the traditional fund of funds. But obviously at that point already people started to understand it wasn't just about having fund of funds and putting it into your portfolio. It was also about building up the due diligence around that, both from a manager and operational perspective, and bringing that really up to the latest standards. As we evolved and the bank started to come out of the financial crisis, we also started bringing together within our remit a lot more of the other countries. So to today, we're active in more than 10 countries. We've got more than 100,000 clients, representing over 176 billion in assets, which is very different to where we were. So we've had to evolve the offering correspondingly. So what that also means is, following the crisis and Madoff, we started moving more to the use of managed accounts and funds based on managed accounts. And that's how we started our offering. Now, today's quite a different environment as well. Given AFMD, given the evolution of alternative UCITS, given the environment of toppy markets, we're at all-time highs again, but also on the fixed income side where, let's face it, that's where a lot of traditional private banking clients are allocated to, and they see the problem of low yields and the potential for rising rates. So that's a bit of the backdrop as to where we have come from, but also where we need to go to. So one of the other things we've done also is build up the assets from a couple of $100 million to today where we're at over, I would say, $3 billion allocated to hedge funds in particular. And that ranges from the traditional offshore fund of funds through to onshore fund of funds, single manager funds, single manager managed accounts, and also even more so now the alternative UCITS funds. So we've got a whole set of solutions for all different countries and different client types, and we're looking forward to actually increasing our penetration because our core holdings should be at 5% for all clients. But you just need to do the maths. At 3 billion, we've still not penetrated the 5% of the 176 billion. So we've still got a lot of growing to do, and I'm looking forward to getting that message across. But of course, having to deal with 500 relationship managers across 10 different countries is not an easy job, and particularly given the negative connotation that a lot of people associate with the term hedge funds. So one of the things we're trying to do now is also to re-educate on the term and also how people think of hedge funds. And we want to get actually the advisors as well as the clients to think of hedge funds not as the magic bullet which was the cure for all, which is pretty much the sort of the pre-08 approach. This is more about having dedicated solutions for dedicated problems. What do I mean by that? Well, the average private banking client looks at his portfolio and he's got an allocation to fixed income, so he thinks of fixed income, and he thinks of equities. Well, if you go to him with a fund of funds, which is difficult to explain and doesn't always behave as it should do, he finds it very difficult to accept. So one of the things we try to do is to break it down into the way the clients think. And not a lot of fund providers have actually thought this through or presented themselves in this way. So we're trying to provide now a equity long-short fund of fund solution. So we've actually just done that recently, well actually this week together with Peak Day, where we've actually launched a dedicated fund to actually approach exactly the client's needs. They understand that equity markets are reaching their top. There still might be some upside, but they are worried about the downside. So a fund of long-short hedge funds is the way to go about that. So we've just now raised 170 million for that fund upon launch. Similarly, most clients are actually worried about the fixed income markets. They see, they're getting yields of 1 to perhaps 3% if they're going a little bit down the risky side. But their biggest worry is what happens when interest rates go up. Now, most clients understand this, but they don't know what to do about that. So the biggest thing they're worried about is diversifying their risk. Now, we've actually got some products in place for that. So this is a fund which we launched with Lixor some time ago, based on managed accounts. I think we were quite pioneering in doing that. The fund now stands at about $600 million US dollars, but it's getting the message across. That's the harder part. So what we want to try and do is to focus on getting the relationship managers to understand this is a great diversifier for the client who's got this fixed income problem. We've done that now and implemented that in our discretionary portfolios, but we've got to now get that message out throughout the network.
So Marc, you are convinced that hedge funds and alternative investments are serving your private client, but you need to get through the relationship manager to really help people allocate. So what have been the challenges that you faced when talking to the relationship managers, and how did you go about making it clear to the relationship managers that alternative investments make sense, particularly now?
I think there's about 4 or 5 different topics that we need to tackle here. And to be honest, most of the relationship managers don't understand this, but also the support we get from the fund providers is also not sufficient because they don't understand these 5 points. So let's start with regulation. That's the first one. No one was even prepared for AFMD and the consequences that would bring about. So, for example, for the traditional offshore Cayman funds, even if there's ways around AFMD and the manager is now AFMD compliant, he can't sell those to non-professional clients. Well, within the private banking, even the family office space, most clients nowadays are still non-professionals, i.e. they are retail. So that's the first hurdle we have to overcome, and to get both the managers to provide us with the right product, but also with the relationship managers to understand that they can't sell the traditional offshore funds anymore. They have to focus on the onshore UCITS type funds now going forward. That's the first challenge. Number 2 is on the fee side. So in my position, we're quite lucky because we actually also work on the long only side. And here in the Netherlands, one of the big efforts we put into over the last year has been on the RDR, so retail distribution review, whereby, as in the UK, the bank no longer gets paid by retrocessions from a fund manager. They get paid by charging the client directly. So this has brought about the introduction of clean share fee prices, meaning it's no longer good enough to charge 1.5% or 2% to the client in the management fee, and the bank receives a retrocession. We've seen now the fees coming down to 1% and less. So we certainly see a fee compression on the hedge fund manager side, but the issue is when you talk to a relationship manager, he will look now what we see on the long-only side, particularly the passive side, where they can get funds for 10, 11, 12 basis points. So comparing 10, 11 basis points to 100 or basis points or 1% is quite a big difference. So we're actually using our bargaining power to work with a limited number of hedge fund providers to actually negotiate the fees down on behalf of the clients. So this makes the proposition far more interesting from a client perspective. They no longer think they're paying fees on top of fees on top of fees, and they also think they're getting a unique proposition. So fees has also been an important evolution in the last 6 to 12 months. The other issue is also in the marketing. It's no longer good enough just to do a performance fact sheet where you have some key numbers and a nice performance chart. You actually have to go in and explain what you're doing. Now, this is not a unique problem to the traditional offshore funds, but even to the UCITS funds, where, in many cases, funds, all they do is list the performance. Clients don't want that. They come from the long-only world where they want to see what the top holdings are. They want to understand some commentary as to what the fund manager is doing, and an explanation of what he has done right and what he's done wrong. That is actually failing in many cases. So we actually spend a lot of time with the managers trying to explain to them how to communicate in retail language. And that's one of the difficulties coming from sort of an institutional background, as most hedge fund managers do. They're just not used to talking the retail language. So what we see actually is some managers now are hiring people with that specialist background, but if they want to actually distribute more and more to the wealth management industry, they're going to have to open up and improve the communication. So that's another challenge. And then I would say finally, it's also on the transparency. Now we've seen more and more come about, be it either through the use of managed accounts or even UCITS, but even the offshore funds are becoming more transparent. But then they shouldn't overload investors as well, because we have to act as the interface between the clients and the relationship managers, and giving us a lot of attribution analysis is not always useful. You need to be able to synthesize it into a key few points. And that ability to translate that into something useful is key and paramount, but it still requires a lot of work. So what we find, the skills that we have to have, and within my team, is we need to be marketing specialists, we need to be regulatory specialists, we need to help on the sales and marketing, we need to understand the product, and quite often we also have to do battle internally with legal, risk and compliance. They've understood the product. So the other final part is making sure that we've got the right skill sets to actually interlink and interface with all these key stakeholders, because it's not just about us going to the relationship managers, it's the whole value chain. And that is also extremely time consuming, and is where we also need to spend a lot of time. And getting that message across to the relationship managers and that they need to help us in the selling process is quite a challenge.
Mark, in the last years, UCITS in Europe, but also globally, have taken a huge upswing and have become more and more important. Now, for ABN Amro Private Banking, how do you work with UCITS, and how do you relate them to hedge funds?
I think that's actually a very poignant question, and again, not something that has necessarily been appreciated by either the bank itself or even product providers. One of the key challenges we face is how we actually define what a UCITS alternative fund is. So as funds have become more and more popular, you see them pushing the boundaries a lot more in how they allocate and how they implement their strategies. Probably a little bit less so on the equity space, so the long-short equity space. That's usually quite clear when it is a hedge fund. But in the fixed income space, that area is a bit more grey to define. So at what point does portfolio hedging or optimization turn into active trading? So the use of derivatives to do active trading in the fixed income space. So again, this is one of the big challenges we face, because it has implications not only on how a fund is held in a client's portfolio, is it held within the fixed income part or the alternative part, but also it means how do you approve it, what are the system changes you have to do internally, the classification processes, and also how you present it towards clients. That's one of the issues where I think that many advisors and providers haven't fully appreciated what we're doing. So what we need to do is we've actually come up with a set of rules on how to define what is what. But as you said, that has plenty of consequences, and trying to get that message across through to more than 10 countries and all the different advisors, but also all the different stakeholders within the bank, requires quite an effort as well. So what that means is that we think there's going to be a considerable growth in that space, because again, the alternative UCITS in the fixed income space is what's going to help a client protect his portfolio in the future, but it needs to be clearly understood. And we're not helped by certain managers labeling their funds absolute return government bond fund, for example, because people think it's a government bond fund, which it clearly is not. But you have to dig down into the prospectus, really understand it, understand the trading styles of how they also implement it, and then giving that message across throughout the network, because it's far too easy for someone to pick up the performance figures, look at the fact that it's a government bond fund in its title, for them to completely misunderstand it. So I think the industry also needs to man up a little bit and to be clear as to what a fund is doing, and to make sure that we don't missell something to our clients. Other things we have to also make sure, of course, is that if we are selling UCITS funds, that the strategy is also UCITS compatible. And we also want to make sure that they're not just shoehorning a strategy into that wrapper simply because they want to distribute it. So it's also really making sure that we're understanding the tools, the liquidity, and given the trading changes, with a lot of banks now getting out of prop trading, you see liquidity is different to how it was 2 or 3 years ago. And so we need to get a good understanding of how that implements what could be a liquid fund, but what happens if all of a sudden there's a big redemption. One of the advantages of being this big is that, as I mentioned before, we can negotiate on fees and make good allocations. One of the disadvantages, as soon as we don't like a manager, we will pull out. But we want to also make sure that that doesn't impact negatively investors or clients, because they've experienced that before. And you only need that to go wrong once for them to remember exactly what's happened in the past, and you've broken that trust. And one of the things that we are quite proud of within ABN is that we are seen as a trusted advisor to clients. We don't give them the usual higher risk type products. We want to make sure that the products that they have are well understood by us and by them.
Marc, at ABN Amro Private Banking, when you work with hedge funds or alternative investment managers, how do you screen them? How do you select? What are you looking at?
I think quite a lot has changed in the last couple of years. So as I mentioned, we're moving more and more towards UCITS, which means we also need to change the way we look at funds as well, be it from a manager due diligence perspective and as well the operational perspective. So we need to go far more in depth as to how they are doing things. And in fact, we're actually doing offshore hedge fund due diligence on onshore funds nowadays, which not all managers are always ready for. As to the types of managers we're looking for, this depends. So we actually have split up how we provide certain managers and funds to clients. So for discretionary portfolio management and less active investors, we're going to provide them with building blocks, i.e. fund-of-fund structures. And that's the only way to ensure that they are properly diversified and that they're able to switch between the strategies quickly enough. So we leave that to the manager. But then on the other hand, we also have active trading clients, and they will want to, these are clients who usually have a bit more knowledge and experience themselves and have an idea of what they want. So we actually need to find managers which fulfill their requirements. So these will be single manager UCITS, and we're looking to expand upon that over the next couple of years. And that can be either in the equity space, so again, a nice hedge to the long part of the portfolio. So that could be in the market neutral space, or it could be in funds which are really decorrelated from the traditional equity markets, or even just diversifying as well. Although what you see is a lot of equity beta quite often in the in the UCITS long-short space. On the other hand, what you can see is more in the diversifying strategies, and also in the relative value and long-short credit space. That's where there is also some interest. However, what you see is that you do eliminate if you're using UCITS, you do eliminate the distress space, which has traditionally been an interesting driver of returns. So the question is, are clients willing to lose that illiquidity premium, or do they just want something to diversify from their current portfolio? And I think we see enough trading strategies coming on board now which are able to diversify returns. That's simply because they are long-short, because they're using CDSs, hedging the duration of the portfolio. So that actually nicely complements what investors have on the long-only part. But for that, you really have to go in depth to the trading strategies, understand what they're doing, have they got the resources, have they got the right systems in place, look at the liquidity, operationally are they set up, and quite often just having a 6, 7, 8-man UCITS team is no longer good enough. You also want to make sure there's the independent risk. You want to make sure that The liability of the directors is well understood because they need to be monitoring what's going on, and it's no longer the same perceived liability as with a long-only manager where basically there's only benchmark risk. Here there's a lot more scope for things to go wrong, either from liquidity, trading, operations, legal and compliance even. So what we're realizing is that managers are having to beef up what they're doing and their teams, and we actually need to beef up how we look at managers as well. And I would say those are the two key areas. Now, of course, from a fund of fund perspective, it's a little bit easier, but we also want to make sure the fund of fund manager is doing his work and not how they used to, where they just basically are trying to build a portfolio. And where we see actually strength is the transparency that either the UCITS funds or managed accounts which invest into fund of funds are being used, because then they can use the transparency provided to make the right allocations, but also understand what's going on in the right strategies, and also look at the risk that's involved with that. Stress testing the portfolio. One of the beauties of the transparency is that you're able to properly stress test portfolios now, and you're able to show a client, well, if this is your long portfolio and this is your alternatives portfolio, what happens if you stress both? So you can show what happens if equity markets drop 10%, and you can show what happens to the alternatives portfolio if equities drop 10%. And that you just could not do that before, and more clients are able to understand that. So that's going to be a very powerful tool in explaining to clients why they should hold that in their portfolios. But for us to make sure that, from our perspective, that also the managers are able to do that in a systematic, but also a coherent and consistent way as well.
Marc, what are some of the current developments related to alternatives or hedge funds within ABN Amro Private Banking?
I think there's a couple of different angles here. As I mentioned already, we're moving more and more into the UCITS space. That's a general trend we see throughout Europe anyway and across the bank. However, as per 1st of September this year, in Germany, we've taken on board the assets of Credit Suisse Private Banking. But there's also an interesting team there involved in private equity. So historically we see that there's a natural aversion to the word hedge funds in Germany. However, in Germany there is a keen interest in private equity. So we're hoping to build upon that team and integrate it within the network. And we're going to follow a step-up model. So we want to roll out into Germany over the next 12 months and launch a couple of new products. But then to bring that out throughout the rest of the network and throughout Europe and the Far East. And if we reach the same penetration rate of nearly 10% of assets as they have done in Germany, that should put us in good stead going forward. And we hope also that will help to dispel the fear of alternatives, and we will also see an increase in the penetration rate of hedge funds as well. But again, we don't want to call them necessarily hedge funds, we might call them specialized funds. The other part also, within ABN AMRO, we also have a dedicated sustainables discretion managed portfolio, and we've also been busy developing a new product for that. Essentially, they would invest into, for their alternatives part, they would invest into sustainable alternative products, be it either in the real estate, microfinance, or even the hedge fund space. But the problem is, again, with AFMD coming into place, we couldn't include that into portfolios going forward. So we had to develop a specialized wrapper, so a low-cost wrapper, which would be regulated for public distribution here in the Netherlands, and would allow us to allocate then to other alternatives. So we're looking to use that as a stepping stone, not only for the discretionary portfolio, but we will hopefully can roll that out to advisory clients going forward to give them an interesting sustainables offering going forward. But in order to make that happen, we had to work very closely, not only with the provider, so in this case it was Previum, based here in the Netherlands, but it was a whole transaction because we had to lift out the assets from clients' existing portfolios into this new vehicle. So that included, something like 1,000 clients with 4, 5, 6 lines in some cases. So there's about 10,000 reasons for the transaction to go wrong. So we had to involve many different stakeholders in carrying that transaction. But now we have an interesting sustainables offering in that space as well. Married to that as well, I think there's going to be a growth in the space of sustainable investments as well. And we're actually actively researching that now, either in the microfinance space, in the alternatives on the hedge fund space for sustainables as well. Although in some cases the word hedge fund and sustainables might be a bit counterintuitive, we see certain niches there as well, which we're looking to expand upon. But again, that's a 200-300 million growing base, and we see that growing quite considerably over time as we focus our positioning in that field.